Preston Parker CPA, accountant in Scottsdale, Arizona, recently shared some thoughts regarding the fraud and accounting gimmicks. Based simply on cyclical adjusted price to earnings, the market is significantly overvalued with a reading of 23. However, even this measurement understates the true nature of the bubble, because one of the biggest drivers of corporate earnings in the post-2009 era is financials. They account for 16.8% of the S&P 500, second only to it. And financials earnings are a complete fantasy derived via accounting gimmicks. Banks and other financial institutions are required by law to maintain a certain amount of capital to make up for loans that borrowers default on. No matter how hard a bank works to only lend to those who won't default, inevitably a certain number of loans go bad. Loan loss reserves are expensed against earnings. So when you raise loan loss reserves, your profits fall. Profits equals sales expenses. And in contrast, when loan loss reserves fall, earnings are higher even though the bank hasn't technically made more money. Preston Parker CPA also shared accounting and financial report tricks. While most companies report their results honestly to investors, a significant number use accounting or financial reporting tricks to hide the truth. Since they are likely to be unaware of management's integrity level, smart investors would do well to maintain a healthy skepticism and perform rigorous due diligence with regard to financial reports. Additionally, financial shenanigans occur in every industry and know no geographic borders. Thus, investors following companies headquartered in China, for example, will benefit as much as those interested in companies based in the United States, Brazil, or any other country. Our universal message is that investors should assume that the urge to exaggerate the positive and hide the negative will never disappear. And where temptation exists, shenanigans often follow. But there's more, according to Preston Parker CPA, accountant in Scottsdale, Arizona, as set out below. For a banker, what's not to love about the right not to recognize even massive losses on assets? He gets to keep his job, reputation, and obtain bonuses for blowing up the bank. For a senior regulator whose failures allowed the bankers to cause the epidemic of mortgage fraud, FBI 2004, the mother of all bubbles, and the Great Recession, a cover-up is ideal. Bank failures are supposed to lead to investigations by the Inspector General and can lead to embarrassing congressional oversight hearings. Bankers and bad regulators sell the cover-up to legislators as the miraculous, silver bullet solution that can solve a crisis at no cost. Legislators wish everything they do could be that easy. Among my most painful memories of being in their offices to listen to their explanation of how simple, cheap, and pleasant the cover-up will be. Everyone wins, no one loses. It's just like the financial bubble that inflated the fictional asset values. Remember how wonderful the bubble was? The cover-up pretends that the bubble prices were real. The cover-up strategy says that the answer to a bubble is a bigger, longer bubble. Fiction can be so much more pleasant than reality.